From the University of Westminster, this is The Week Ahead with Dave Coker.
All right, guys, it's Sunday, November 8th. This is The Week Ahead. My name's Dave Coker. Let's see what's going on. So in terms of key events, first of all, we saw Mr. Biden won the U.S. presidency. I put wins in quotes there. Now, we know the election's contested. I'm not going to get into the validity of claims or counterclaims, things like that. But the simple fact is there's claims out there of problems with the process in various states. All I'll point out is, as an American, I remember back in 2000, Al Gore thought he had won the U.S. presidency for 36 days before it was overturned and it went to Mr. Bush. We'll have to see what happens. It's not totally clear. We do know that the virus is resurging. We're starting to see record number of cases in the U.S. and other nations. Pay attention to that. That's something that's going to be impacting everything this week. Wall Street and Mr. Biden. Wall Street's actually welcoming Mr. Biden's election because they're more interested in the removal of the uncertainty, although it looks like there's even more uncertainty still present. But we'll see what happens this week with Wall Street and Mr. Biden. And a lot depends upon Mr. Biden's plans for when he enters office. Now, there are things called executive orders in the United States. And Mr. Biden said he's going to roll back a lot of the changes that Mr. Trump brought in. We'll have to see if he rolls back that 2017 tax cut, because if he does, if he sharply increases capital gains taxes, if he sharply increases corporate taxes, we may see the markets correct. And not really anything really untoward. We'll just see them correct to new levels on the basis of new data. Fed speakers all over the place this week amid key data. We'll point it out on the day by day. And finally, Brexit. This is the end game, guys. We're in the final inning. We'll have to see how it goes. Here's the S&P 500 for 1 week. My gosh, remember last week? You can see what a change we've had. Look at the winners here. Microsoft up almost 10.5%. Amazon up well over 9%. Google roughly the same, about 9%. Apple 9%. Pretty amazing. Even Berkshire Hathaway, BRKB, down there in the left-hand quadrant, you can see is up some 3.5%, 3.4%. Really wild across the board. Only a few industries lost. You can see down there energy not doing super good. Some of the regional banks and basic materials as well got whacked a little bit. Here's an interesting one we haven't looked at before. Analyst recommendations. Now, guys, I think it's a load of rubbish, tracking analysts and buying only when they recommend a stock. But still, we have to pay attention to these things. And you guys, you can see that they're still recommending Apple. They're still recommending Amazon, even though these companies have run up massively over the past year. It's a little troublesome, in all honesty, but we won't go too deep into it. Once again, go on FinViz and you can actually get the detailed data and the interactive chart if you're interested. So where are you going to put your money? Here's an interesting one, guys. What if we were to take a look at the housing market? And you can see here, delinquencies, my God, are soaring. Look at that line. It's straight up back in March. We'll have to see exactly what happens here with delinquencies as a function of total loans that are outstanding. We are going to also try to put money in markets that are performing well. And here you can see that the emerging markets tending to behave better than the United States. It's really wild when you take a look at what's going on with China, when you take a look at what's going on with emerging markets excluding China. China is the engine presently for the globe. And right after the Corona crash, I moved some money into EMD, a wonderful ETF that pays a dividend monthly, and it's tied to emerging market debt. And that's performed very well over the past few weeks on the back of this news about emerging markets tending to outperform developed markets. In fact, it's performing so well, you can see the MSCI China index has risen to a near-term high. It's pretty interesting, guys. We'll have to see if we exceed levels we saw back in the late 90s. On the left-hand side of the chart, you can see what the level was, but it's looking pretty darn good so far. Lockdown 2.0, we're living it. And the thing you have to be aware of, guys, is the debt to GDP ratio is the highest we've seen in quite a while. You can see the mess they had back at the end of World War II, 1940s, late 1940s, early 50s. They paid this down. And when they paid that debt down, guys, the UK went through a real sharp adjustment of living standards, because basically what happened was they had to increase taxes, they had to cut government spending to pay down the debt. And they paid it down, and everything was really good, throughout the 2000s. We saw a financial crisis, it started to spike up, and it never really recovered. And now, with the pandemic, it's set to soar. They're spending far too much money, guys. And as I mentioned, there's only two levers the government can pull. They can raise taxes or they can cut spending. In actuality, they won't do one to the exception of the other. They will do both. So I expect about 2 years out, taxes in the UK are going to rise, spending in the UK is going to fall. Austerity 2.0. Oh my God, I was doing so good with my animation. I don't know what happened there. Don't worry about it. Here we go. On Monday, November 9th at 12:20, FOMC member Harker speaking, followed up a little bit over an hour later, FOMC member Mester speaking. Check both of them out. Once again, guys, you don't have to worry, you don't have to wonder, you don't have to speculate about what the Fed is going to do. Take a look at what the FOMC members say publicly. And then you've got a good idea where their vote is going when they hold a meeting and they say, should interest rates remain the same? Should interest rates rise or should interest rates fall? You'll already know this stuff. We've also got T-bill and note auctions coming out. So we got the 3-month, 6-month T-bills and 3-year note auctions. Once again, this is a 20-year chart down here, and it gives you an idea about just how low interest rates are in the US right now. And you can see for some of the tenors, we're hitting record lows. It's absolutely incredible. So 3-month money coming in at 9.5 basis points. 6-month money, 11 basis points, and 3-year notes priced to trade at roughly 19 basis points. Incredibly low interest rates for the risk you're taking, guys. I tend to think that of U.S. Treasuries, T-bills and notes, and even longer-term bonds, I kind of call them as return. I view them as return-free risk. You're picking up a fair amount of risk here, holding on to this stuff. And you're not really getting compensated adequately. I don't really like treasuries at this point. I tend to put my money, as I mentioned to you guys, in high yield. All right, Tuesday, November 10th. There we go. That's a beautiful animation, isn't it? At 08:55, we got the Red Book month on month. Prior was 1.2%. We don't have a forecast. We're looking at the year-on-year data. 3.2% was prior. We don't have a forecast. Once again, this measures business activity. At 10 a.m., we got the JOLTS, Job Opening Labor Turnover Survey. Job openings reporting for September. Prior was 6.493 million. Forecast is 5.59 million. So an improvement in terms of job openings that we expect. And finally, at 1700 hours, FOMC member Brainerd is speaking. Wednesday, November 11th at 06 a.m., 0600 hours, we got the OPEC monthly report. 0700 hours, we got the MBA, Mortgage Bankers Association, mortgage applications. Week on week, prior was a 3.8% increase. No idea about the forecast right now. Basically, what's going on in the States, because of the pandemic, anyone who can is getting out of the cities, and they're selling and they're buying out in the rural areas and the suburbs and things like that. It's mirroring what's going on in the UK and in other Western economies. So we're seeing mortgage applications. They were up pretty healthily last week. We'll have to see what happens here. And here we got the Thomson Reuters, at 11 a.m. we got the Thomson Reuters. We got the Consumer Confidence Survey for November. Prior was 52.64. We expect to see a little bit of a weakening in confidence. We'll have to see how this comes out. Thursday, November 12th, 0830 hours, core CPI year on year for October. Prior was 1.7% increase, forecast 1.7% increase. At 0830 hours, got core CPI month on month for October. Prior was 2/10, forecast 2/10. Once again, guys, core CPI strips out volatile components, namely food and energy. And they just report other components of the consumer price index. At 0830 hours, jobless claims, initial jobless claims. Prior was 751K. We're forecast to come in at 738. Slight improvement there. At 0830 hours, jobless claims 4-week average. Prior was 787,000. We'll have to see what happens here. No forecast. Friday the 13th, my gosh. 0700 hours, FOMC member Williams is speaking. 0830 hours, PPI, Producer Price Index, month on month for October. Prior was 0.4%. A slight moderation here, forecast to drop down to 0.2%. At 0830 hours, we got PPI year on year this time. Prior was 0.4, forecast at 0.4, forecast to come in at 0.4. And finally, rounding out the day, at 0830 hours, we got FOMC member Bullard speaking. All right, guys, this has been the week ahead for November 8th. Once again, have a safe and profitable week. You can make money in the markets no matter what is going on. You just have to be aware of news that we're expecting to see come out, and then you have to understand what the impact might be on the markets of this news. Take care.